Hello, ladies and gentlemen. So let's run briefly through what I see as the options, which is what I wrote for you on Tuesday or Wednesday, and I'll forget. But basically, option one is no change in anything. We again get the 1.1 trillion in financing via exactly the same coupon auction sizes and no change in guidance for the future quarters. Now, the twist here would be a change in the guidance to higher coupons in 2026, which I think is very low probability because let's face it, we are only talking about the QRA because Trump said that he had instructed his people to not issue further out than 9 months, and Bessent did not contradict him or push back at any stage. So why would they twist? Why would they change the guidance for higher coupons in 2026? Well, because the deficit is expanding and the TBAC could say that unless they start increasing coupon auctions, they will start running at something like 30% bills. Now that is coming whether they say it or not, but to state unequivocally that they will change auctions to more coupons is incredibly bearish. So without this twist, I think the volatility in all assets should come down. But if there is a twist, it becomes a major steepener. So what are the trades that you do if this comes out with the twist? Without it, nothing much. But with the twist, 530s will steepen, everything will steepen, the whole yield curve will steepen. It's incredibly bearish as well longer term for equities, but I think they will very, very quickly do a move down, and you will see later on in the video where the support levels are. I think it'll very quickly take a quick bath, as I put, down to 6,300 and then the 6,205 SPX support. What you can do before QRA to hedge yourself, well, it's obvious, buy 1% out of the money puts for expiring on Wednesday. Don't forget the QRA comes out at 8:30, so you have the whole day, and then you have FOMC as well. The FOMC, we all know they're going to do nothing, so I don't think volatility is going to be particularly high for that. But as you can see, the move is going to be quite large. And after QRA, if you haven't done it, what I would buy some Friday at the money puts and sell 6205 strike against them, so I would have a put spread with the upper part wherever the money is, wherever you've managed to buy it, and the lower around 6205 on Friday. The dollar should strengthen a lot because everyone is off sides. And you get this steepening move. You get the 10s and 30s, going up in yield quite considerably. And that should actually help the dollar quite a bit. And DXY should trade 98.81. And once again, I will put that, you will see that later, why that level is so important. But everyone will be offside. Because people have some gold, people are short dollars, so these positions are going to get absolutely murdered, including the equities. So they're long equities, they're long gold, they're long euros, and all those positions are going to get absolutely murdered. So, if you want to play in FX, you can do Wednesday puts in ECU25 and gold. Anything just slightly out of the money, they're going to be very, very cheap. And the whole idea of these trades that I'm showing you here is that if they don't work, at 8:31, literally you dump the position. What are you going to lose? A few ticks? That's literally all you're going to lose, and you move on. But you will be hedged either whichever way you want to be, aggressive or not, for the QRA, because it really could move stuff a lot. And I think gold in this scenario goes all the way down to 32.75 in minutes. So I'm giving you the levels, and I will amplify on those levels later on in the video so you can see where I think it goes immediately. I mean, within a few hours on each QRA scenario. Now, this one I give 1% probability to, and I think it's so unlikely to happen. But 2, 3, and 4 have slightly higher probabilities. Let me actually restate that. No change and no twist, I think, is probably, I don't know, 80-85%. With the twist, I think it's 1%. So let's continue that. Now, some sort of reduction in long coupons, i.e. 10s, 20s and 30s, but no addition to 2s and 5s area. That is implicitly means that you are financing it via bills, and naturally the more the reduction, the more bullish it is. If it's 100 billion that they take off the 10s, 20s and 30s and shove it into 2s or 3s or 5s, it's a big deal. It's a hell of a lot. And people will just be squeezed on duration like crazy, and it means they want to run the economy very hot. But it's also a debasement story, a dollar debasement story. So the trades that you can do to take advantage before that happens is long gold Wednesday 3400 calls. You buy those calls, it'll go a long way through. You will see later on in gold, I think it'll go through 3500 in no time at all. You can be long 118 and a quarter Wednesday calls, and these are all 0 day to expiry stuff that is going to cost you almost nothing. You can be long US or TY call spreads, something like 115, 117 in the US for 1 to 2 weeks, because I don't think that the curve will adjust that quickly. It will go, but it's going to take some time. It's not going to be the kind of move that you get in gold or in euros. I mean, I would have those on as a hedge, and then you can go and do the euros and the bonds, and you can do ES. You know, you just buy at the money 0 day to expiry calls. It should go at least 1 to 2%, at least. So you have all risk assets flying. It's debasement with strong growth. Just buy gold if you haven't done anything before then. Sell the dollar. I mean, Dixie is going to go and test the lows at 96.47 almost immediately, I would have thought, and buy equities. So what you want to achieve is a portfolio that is long of equities, slightly long of the long end of bonds, because I still think that they're going to have problems, but in the meantime they're going to go 2, 3, 4, 5 points, no problem at all. You want to be very long of gold, and you want to be short of dollars. So that one is easy. Now, a twist where they take some off the 10 plus area and put it into the 2s and 5s is a variant of 2, but just less obvious. You know, it's a flattener. You flatten the 2s, 5s, you flatten the 2s, 10s, you flatten the 5s, 30s, and you'll see later on the levels that I think it goes to. But equities should really like it. There is absolutely no reason why they would go down on that. And therefore, you know, having some calls before that is the way to do it. Instead of going 2%, the equities will go 1%, but there it is. Everything else, the dollar, and gold is marginal on that one, right? So I really wouldn't do anything apart from flatteners as it comes out, and equities immediately 0 day to expiry at the money calls, because if they're only worth 15 to 20 ticks, it's going to go to 50. So that is what you want to be doing. Now, no change in issuance, just like one above, but an announcement that they will increase substantially the monthly buybacks of long off-the-run coupons and not substitute them with newly issued on the runs of the same duration but bills. That now depends on the size. If it's something like 30 billion in size, it's really the equivalent of something like a 10 billion QE. I'm just guessing here, but sort of finger in the wind, that is roughly the size. And this is still bullish all risk assets. You are basically trying to do the same trades as in 2 or 3, just less pronounced and less permanent in effect. But what I would say is that 1 is bearish equities, 2 is very, very bullish gold and bearish the dollar, i.e. bullish euros and bullish equities. But the more diluted it is, so 3 and 4, it puts the onus back on the data. Data becomes important again. If it's 2, you can forget about data. Who cares about what Q2 was? Who cares what NFP is going to be on Friday? It's just an easing, right? It's the equivalent of the Fed having just these 50 basis points. You don't think about what the data is going to be in 3 days' time. You just react. You just go with it. It's going to go a long, long way. 3 and 4 are less obvious than 2, and in that case, the more the data that comes out later will matter. So if 2 comes out, I would really go gangbusters. If you normally trade a 10 lot, I will do a 25 lot. That kind of absolute conviction that things are going to move. 3 and 4 go back to normal size, and be careful of the data that comes next, because that will also be important. That is really what I think and what is most likely to happen. Now, if 1 has a 1% chance with the twist, I think 2 has probably got a 5% chance, and 3 and 4 have got another 5% chance cumulatively, as it were. So I don't think that there's more than a 10 to 12% chance all in all that 2, 3 or 4 come out. And I still think the most likely outcome is this one with no twist. That to me is the most likely. But if Bessent really wants to leave his mark, he's going to do 2 or some combination of 2 out to 4. So now let's have a look at what is likely to happen to bonds in each of these alternatives. Very little, I think, is going to happen to the 2-year, whatever the decision is in the QRA. If they decide to shift more issuance to the 2s and 5s, yes, you might get a few basis points, but all you're going to get is into this area between 4 and 405. As I have written before, for us to go higher than this 4 to 405 area, we need to start abandoning the idea that the Fed is going to cut twice and that we are going to get an acceleration of cuts after May next year. And really, the 2-year isn't really going to care whether we have 1 cut this year or 2 cuts this year. It really matters what is the terminal rate, and as long as Powell is going and he will be replaced by someone more dovish, which seems to be odds on, it's very, very unlikely that the 2-year goes through here. What could happen is naturally that the 5-year goes up quite a bit, more than the 2-year. If you have one with a twist, then you are really looking at something like the 530s moving by quite a lot. And you can see where we are in the 530s. I think then we come straight on that day, we will trade through this 109 level. And as I've showed you before, then after that, you're looking at this 125, 123 to 125 area, that kind of story, and even lower. It is a natural steepener. One with a twist is a big steepener. All the others are really flatteners. So if you look at 530s and you get 2 or 3 or 4, you will get some modest flattening. I would have thought 79 is just about as far as it goes. And if you look at something like 2s, 10s, yes, we might go through this 41 level. In fact, we definitely will. But I really don't think that we go through the, this 200-day moving average very much. 2, 3, and 4 are flatness, and there's no question of that. We will go and touch the 200-day moving average in the 2s, 10s. And that's why I keep on saying that really 2s are not going to do very much either way, but the 10s and the 30s will do better under 2, 3, and 4, especially under 2. But it's, again, unless it's 2, and I think the odds are very low, 3 and 4 are really going to depend on the extent that the market goes and sustains on more data, and the data will become critical. On the first day, I really don't think that we go any further than something like 34, 35, something like that. But you can see that if we're still here on Wednesday morning, you're looking for 10 basis point move on 3 and 4 kind of thing, and probably 15 or so under 2. 30s are definitely going to be interesting, because I think they will, under 2, they will collapse down to 472, that kind of area. And really where they started the year, this is where they started the year, and it's likely that they go right back to there and then slowly, maybe even lower. But if it's one, with a twist, we are going to break 511, and that's going to get very, very nasty. After that, you have 526 and 539. I really would not be surprised with that within a week of one with a twist, we are up here, 530, 539. Big move, nasty. It really is going to affect equities quite badly. One of the big moves under 2 and mostly 3 kind of thing is going to be the 10s Germany against the US. You are looking for this kind of level to start off with, 152, so that's 15 basis points move. That is another low risk strategy that you can have on if you think that that is likely to happen. I don't think it's, I've told you what I think the odds are, but that is the kind of strategy that you could have. That is not a high risk one, I don't think. I mean, the odds of one, as I keep on telling you, one with a twist are very, very low. I mean, I said 1%, but who knows? If you think that 2, 3, and 4 are more likely, you can naturally do 10s, and I think eventually, if not the same day, they go 152. And that is also the reason why the dollar really is not going to like that. So let's have a look at the dollar, and under 1, I think that it's going to go very, very quickly back to 98.81, where the daily Bollinger Band is. I think there's going to be very little trading. Everyone is, I mean, not everyone, but most people are short of dollars. And if that were to happen with a twist, and you're talking about more coupons next year. You're talking about, as I showed you, the 30 years going, trading 511, busting through, going to 525. That is going to bring out all the differentials rather, and then you are looking for a big move in the dollar. And I don't think 98.81 holds it. I think it probably goes all the way to 99.83, and someone will call that an ABC retracement or whatever, but that is the kind of price action that I'm looking under one with a twist, I should say. One alone, they do nothing, that's fine, but one with a twist and the higher guidance for coupons coming along in future, that is what I'm looking for. And here, I'll enlarge this chart. I think that under 2, you go and you bust 96.47 very quickly. And then, this is the kind of level, the first support level that I can see, 95.07. So under 2 and variants of 2, like 3 and 4, naturally they're all sort of, the later numbers are less bearish, but immediately I think you trade 96.47 again, and then you keep on going. It's going to be an impulsive move. And really, if we take this back and have a look at where the supports lie, you can see that once it breaks this level, it tends to go quite a long way. You are looking for down here. You're looking for the 120s in Euro USD. And if we change it to Euro USD, I will enlarge this chart and I'll show you that it actually can go a hell of a lot further. You are looking for these kind of levels up here, 122, maybe even 125. That's the kind of move that you are looking for if you get the 2. I mean, under 2, the dollar is as bearish can be. It just keeps on going. There is nothing to stop it until these kinds of levels. I suspect the gold is going to be nowhere near here next Friday, because if it's 1, it's going to be a lot lower. I would have thought that this kind of level, 3,200 and just below, and maybe even all the way down towards the 200-day moving average and filling this gap finally here, 31.07, not out of the question. That's the kind of move I expect in gold if it's 1 with a twist. Now, again, that is like a 1% probability to me. If it's 2, it's just going to take off. These highs are not going to hold it. The 34.56, whatever highs, the highest close is here, is not going to hold it. It's going to go straight through, and 3,600 and higher, I would have thought. Certainly on the monthly chart, we've got, this 3,600, and I think it gets to 4,000 very quickly. Within a month, within 2, it's going to be a very big move for gold either way. The only thing that would keep it in this kind of range is going to be 1, no change and no twist, i.e. they haven't done anything, there is no aggressive deficit reduction, the CBO baseline for the financing needs sticks. So the only thing that keeps volatility low in gold is option 1 without the twist. That's just about it. In every other iteration, it either goes up a lot or down a lot, and those are the levels that I can see. This 3150 to 3100 on the downside, and way above 3500. You are looking for all this to the upside, something like at least 200 higher, so you're looking 3,600 at the very least. It's interesting to look at GSG and actually look at the reaction in November of 2023 when the QRA last was twisted, as it were. So it did nothing, went up a little bit, then came down, and then it started a big bull run again. And who knows, maybe the same thing will happen again. But my favorite is that if they do two, i.e., the reduction of long coupons with no addition to short, it's a signal again that they want to run the economy hot. And the economy running hot means that commodities are in demand. I will be a buyer and I will not have a stop on it. I will up my beta allocation to something like 10%. Because let's face it, I want to have at least 30% in Bitcoin and gold and commodities if they decide that they want to do a debasement. And the debasement is two. Everything else is less of a debasement, but still a debasement. And apart from one with a twist. One with a twist, I think, kills the markets, kills all the risk markets. Equities get slammed. Growth is going to be less than we are projecting for Q3 and 4, i.e. for the second half of the year. And we are already projecting quite slow growth. And therefore we will come down hard. But as I keep on saying, that's like a 1% chance to me. If they were to do it, all risk assets, including commodities, including gold, are going to be absolutely, sort of sold to hell. And I really wouldn't think there's going to be any support before 2070. And really the big support is going to be here at 1977. Could easily come all the way down here. If you see one with a twist, you sell commodities, you sell oil, you sell equities, you sell gold, you sell everything. What I've said for gold applies to BTC, and what I've said about commodities also applies to BTC. Very unlikely that we're anywhere near here. If it's one with a twist, you get a move down to this 111,600 in a hurry. It's going to go down very quickly and very hard. But it's going to go up even harder if it's two. And as you know, my odds are far higher that it's two rather than one with a twist. So those are the parameters that I'm looking at. I will certainly be selling all the Bitcoin that I have immediately on the news for an alpha trade, shorting them. And I think even down here is not out the question within a couple of days, around the 106,000. Equities as well, I think, have zero chance of being close to here under either one with a twist or two, or even three or four, because those are all bullish. As you can see, the monthly Bollingers are not till 64.70, and they'll be a little bit higher as well by the time he gets there. So that's the kind of minimum move that I'm looking for, but probably all the way up to these upper Bollingers on the weeklies. And if it's one with a twist, I mean, I'm absolutely positive that we trade back down here. First support is going to be here at 62.85-ish, but we will come back down here to 62.05 as well. Equities are really going to take a big shellacking if it's one with a twist, because as I said, growth is already slowing for the second half of this year. And if they have to then combat with the knowledge of higher coupon issuance in 2026, and the market readjusts for it, i.e. the 30-year goes to those levels from 511 to 525, and the yield curve bear steepens, you are bound to have an effect on equities. Yes, we also have big tech earnings and so on, but it's bound to have an effect. I will be buying puts hand over fist if it's one with a twist. Again, it's a 1% chance in my estimation. but I want you to be prepared and have and know what to do in either case. I certainly think that 60/40 gets absolutely, sort of long-termish, 3 months, 2 months, gets retested if they decide that they're going to up the coupon issuance in 2026. The market's really not going to have that much to look forward to. I've talked about all these possibilities which I consider low probability. I like the 1% for the one with a twist, like a 5% or so for a straight 2, and maybe another 5, 10 combined for 3 and 4. But what we haven't talked about is just what the market really expects, which is really a baseline CBO, moderate tariff income, 850 billion for the TGA, and unchanged coupons for Q4, which is 1.1 trillion, and absolutely no change in the composition, and maybe a little liquidity program buyback increase, which really is modestly positive for risk assets. In which case, as I've told you, then we revert back to data. So if the 80% probability comes true, we revert back to data and we have to react to data. And some of the biggest data next week is going to be the four big tech earnings: Microsoft, Amazon, Apple, and I forget now which the fourth one is. Meta, that's right. And they're all coming out all at the same time, Wednesday and Thursday. So mega Wednesday, huge day. And the more I look at this chart, the more I'm convinced that NQ is not leading anymore. It very, very rarely can go much beyond the monthly Bollingers, which tells me that something is going to knock NQ back. If it's one with a twist, it's going to knock it back a long way. First support, and immediately it's going to be 22,700 on the NDX. First and immediate, and then 22,160. Those are the immediate targets if it gets knocked back because of one with a twist. Again, we could have very sort of worse than expected earnings for those big four. And even if they beat, you've seen how everything else that beats really doesn't get rewarded because the bar is so low, and we know that we're going into a bit of a slowdown for growth in Q3 and Q4. So I don't think we run away unless we have a 2. A 2, and you can forget about the technicals. Just forget about them. It's going higher. Bite calls like they're going out of fashion in everything. And, and this is high beta, so you should go more than anything else. I just don't see it, though. I've given you the 5% probability, and that's maybe too high looking at this chart. Let's have a look at vol and why it would pay to do the option trades that I told you I will be doing on Monday and Tuesday, probably on Tuesday, just to hedge myself against the possibility of one with a twist or 2. So when you're down here, why not do options? It just makes no sense not to. Volatility is okay for next week. Naturally, it's slightly more elevated because of the FOMC, but I don't think anybody's particularly looking at the QRA. And therefore, I would definitely buy some vol or some vol calls as well as a hedge. If you don't want to trade ES, if you don't want to trade SPX options, buying some, 18 calls on the VIX, it's going to be, I think, cheap. I think it's all going to go at least to 22.79. There's going to be a big spike in vol if the QRA is different from expectations, especially if it's one with a twist. If it's 2, it's easy, you just buy the assets. But if it's one with a twist, you're going to get most bang for your buck buying volatility, because you will have a very, very nasty day in equities. Just for you to understand why I think the moves are going to be so big if the QRA surprises, is because I am going to have to do a lot of rearrangement of all my accounts. And this is a very small account, 300,000. This is piddly, but it has what I feel is a fairly good approximation to the allocations that certain people have, or that the big money managers have. So I reckon they're not very far away from 20 to 25% in equities. And I reckon they're all into the short end of the bond market with a little bit of duration, and but not in dollars. So what happens to this under option one with a twist? They hike coupons. I have to suppose that rates are going higher. I'm okay here at the short end, but I'm not okay here at the long end, but I'm not in dollars, so I'm not going to get hurt too much. But if anything, I need to probably reduce the allocation that I have to equities, and I have to reduce the allocations that I have to gold and commodities. This all needs to go, and I'm raising cash. On the other hand, if it's 2 or some variant of 2, you're looking at me having to go to 33% in equities at least. So I have to buy 15% of my portfolio. And think I'm managing $1 trillion. Just think how much I need to buy. And I need to raise this also to 1/3. And this, I need to get rid of the short end, and I need to buy tips, because I don't want any bonds in that scenario. What I want is real rates. I want to be able to buy real rates when they get up there. And I want to get rid of my cash, because cash becomes trash, right? So I have to up a lot my allocation to gold or IBIT or GSG, and I have to up my allocation to equities a lot. That is going to be market moving in many, many ways, and it won't be over in a day. It's going to be a trend, and a strong trend. Finally, I want to show you why I think it's so good to be doing options rather than anything else. Have a look at the 3,400 calls expiring Wednesday. Those expire at 12:30 Chicago, 1:30 New York. 8 ticks, and they'll probably be even cheaper on Monday or Tuesday afternoon. So you buy those and you forget about them. And 8:31 comes along, you sell them out because nothing's happened, or you've made a fortune. Or have a look here at the 3,300 puts, or the 3325 puts, 7 ticks. Okay, you buy those for 6 or something like that, and what are you going to lose in the couple of hours that you're going to be in them? So you buy them Wednesday first thing, 8:30 comes out the QRA. I tweet to you exactly what, if it's 1, 2, 3, or 4, and you either bang them out for a couple of dollar loss, or you're counting your profits times 10. I've done all the levels, but they're not really going to mean very much. My high level point is that under 1 with a twist or 2, the thing that is going to move most are, I would say, gold, then followed by the dollar, and finally equities, I think. And bonds are going to just change the shape of the curve, because as I showed you, I think 2s are pretty much anchored whatever happens. 1 with a twist is a big steepener. You really want to avoid 30s like the plague. And when 30s start breaking upwards, then what you're going to get is really a very, very nasty day in equities. But gold is just going to get killed on the back of one with a twist, but on two, when they decide to run the economy hot and debase, then you are basically saying that gold has no top. And it's going to be a big grab for all risk assets. It really is going to be, volatility cubed in something like gold over days and days and days, because people are going to have to take an allocation where they have 3%, 5%, 7% in gold to much, much higher allocations, and it's such a small market. Or they will have to sell some, in which case it'll go down at least $100. That's the way gold moves. So I think gold options are the easiest way to play the extremes. The FX market is very deep, so I expect it to go in the direction of gold, but at a much slower pace. That's why I think if you really want to lever up one of those possibilities, which I think are pretty remote, as I've told you like a dozen times now, gold is the market to do it in. Great, thank you very much indeed, and I will tweet you tomorrow.